Daniel, hello.
Hi, how are
Hi,
you?
hello, Daniel.
Great. Thank you for joining us at Trader Summit. Now I want to give you a proper introduction, and I'm going to completely Americanize every pronunciation. So just excuse me ahead of time, please.
No problem whatsoever.
All right. If you don't know who this gentleman is, he's the probably one of the more popular European economists around. This is Daniel Lacalle. He's a PhD and economist and fund manager he's the chief economist at Treasuries, author and bestseller of Life in the Financial Markets, The Energy World is Flat, as well as Escape from the Central Bank Trap. He is a frequent contributor at CNBC, Bloomberg, and pretty much every other financial news outlet available. He holds the Certified International Investment Analyst, or the CIIA, and Masters in Economic Investigation and IESE. So Daniel, I hope I didn't screw that up too bad, but welcome to the Trader Summit. So glad that you're here. I know you've been on the Trader Summit before, so.
Thank you so much. Beautiful presentation. You've made, there was absolutely no flaw. So thank you so much for the effort, because it's not easy. So commend. You've been commended for it. Thank you so much.
Thank you very much. Well, it's again, it's wonderful to have you here, especially in this time. And we brought in one of our colleagues. Cohen, you want to introduce yourself?
I hope I'm not going to screw it up either. Buenas tardes, señor Lacalle.
Muy buenas tardes, Colin. Thank you so much.
That's about everything I know in Spanish, okay? Apart from dos cervezas.
With those two sentences, you can get along through life easily. No problem whatsoever.
Right. and that is actually the route pronunciation of your last name, correct?
Absolutely.
Yeah, so myself, I'm a trader of foreign exchange trader. I've been a foreign exchange trader for well, nearly 40 years in banks, FX spot market maker mainly. So I had the pleasure to travel around a few of the main banks and travel around the world a little bit. Went to Japan as well for a while. And so I'm always very interested in hearing what and knowing what economists think about the whole situation. So I'm very much looking forward to talking to you and see what your ideas are about a few things. So Blake, do you want to kick it off, or shall?
Yeah, let's start off with some of the more obvious, and you know, getting your opinions on. And I know you recently did a couple interviews on what's happening in the UK market, the gilt market specifically. You know, K-Man or Cohen, he actually resides in the UK, even though he's Belgian, and he, you know, so we're following the situation pretty closely. But what are your thoughts and what are your opinions on what's happened with, you know, pension funds and this meltdown in the gilt market? And do you think that is really a potential risk to other, you know, bond markets around the globe?
Certainly, I think it is. Every time that we see something like this in the UK, it is a warning, and it's a red flag for the rest of the world, because the UK system is the most aggressively mark-to-marketed, and the one in which pension funds and have the most, I would say, the most advanced trading systems, and obviously the in terms of hedging and looking for strategies to get a little bit more yield out of bonds, certainly some of the most experienced traders. No, so if this is happening in the UK, and it is happening in Japan as well, we should be really thinking that there's an enormous risk of it happening in Europe, in the Eurozone. Why? Because in the Eurozone, for years, we've had negative rates, and we've had the largest chunk, if you remember when we spoke a few years ago, actually, about the massive increase in the trillions of dollars of negative yielding bonds issued. The vast majority of them were in the Eurozone. So all those structures, complicated structures that were built in order to enhance yield in pension funds, in order to improve the profitability of these instruments in an environment of negative yield in bonds, have been implemented in the UK, absolutely, and have generated these subsequent problems of margin calls. The collaterals are not enough. The collateral is going down. Then you have to put even more collateral. The only thing that you can sell in that environment is the sovereign bond because it's the most liquid name. So you bring the sovereign bond down with you because obviously the mismatch between yield risk and the inflation doesn't make any sense for the secondary market. And on top of that, the cost of borrowing rises. So nothing that we haven't seen before, haven't we? I mean, it's the good old margin call. Huh?
It is.
But it's coming to the Eurozone. It's coming to the Eurozone. In the Eurozone, everybody's looking at the UK as if it was the stupid Brexiters doing crazy things. Is looking at Japan as if it didn't even exist. It's not even in the headlines. So that is my concern. Mm-hmm.
Oh, well, you talk about the bond markets, and I'm gonna defer over to Cohen here in just a second. But you talk about like the bond markets and talk about something we've never seen before. Even here in the U.S., you've had these portfolios that are the 60-40 traditional split that has worked literally for decades prior. This is the first year where it just really hasn't worked. So, margin calls are becoming quite common, and you're having, funds, whether it's pension funds or just hedge funds in general, or institutional traders really have to shore up some liquidity somewhere. But look, let me ask you this, because rates are going up everywhere globally, at least we'd like to believe so, even in the Eurozone, and we'll talk about European, energy crisis here in a moment. As central banks go to raise rates and they make rates more attractive, do you think bonds will finally find a bid globally? I'm not talking about maybe the boons or, the gilts, but what do you think there? Do you think there will be a value proposition for government debt at some point?
Yeah, absolutely. But not now. Absolutely it will. The problem is that we are so early in the cycle of hiking rates. And we're just starting to see consensus adapting to the idea that inflation is not temporary, that it's going to be more persistent, and that if you look at, now it's virtually consensus, for example, that in the Eurozone, inflation this year will be around 9%, next year will be around 5%. So is it a good opportunity right now to buy bonds at 2.7% or Spanish bonds at 3%? I bet no, obviously not. So I think that we are starting to see the opportunities in the bond market. They're not in the two extremes of the risk metric of the bond market, in the sovereign side, where bonds continue to be monstrously expensive, and on the high yield side, where yields are still too low considering the challenges of solvency of most of these issuers. But if you start to look at investment grade and you start to look at some of the structures that have been issued recently, you see that there's some healthy demand out there. And obviously there might be still some risk involved considering the outlook on inflation and the outlook on rates. But you start to see opportunities in the investment grade side, and certainly in bonds of issuers in which the solvency ratios have not just not diminished, but they've actually increased, because some in the technology sector, for example, some have actually improved their balance sheet even further. No, so I think that yes, there are opportunities, but I think that the risk is that just because it's, as you very well mentioned, the worst year since 1931 for the traditional 60-40 strategy, actually it's the worst strategy this year. Huh?
Yes.
It is only if you're probably only if you're long only cryptocurrency, but let's forget that one.
But, oh boy, that was a stab.
But no, it's a joke. But the point is that it's probably too early to think that that bonds at 2.7, 2.8%, that Italian bonds at these levels, etc., are start to be an attractive proposition.
Great. I appreciate you answering that. Now I'm gonna pass it over to Cohen, but I wanted to mention to our viewers here at the Traders Summit, one of the benefits of being here at the Traders Summit is you have somebody of the caliber like Daniel here. You're not hearing him on CNBC. You're not hearing him on Bloomberg. If you have any questions, jump in the either the chat box or the Q&A panel. We'll try to grab some of these questions towards the end of the presentation, but get them in. Obviously, we're not, Daniel's not going to be able to answer all of them, but if you have some questions, bring them in. Cohen, I know there's some topics you wanted to bring up, so let's get into them.
Okay. Hi, Daniel. Thanks for being with us again. I wanted to, if you can and allow, I wanted to take you on a little bit of a world tour about what's happening on the supply side politics, because there's a lot going on in politics, call it geopolitics or even politics. And if you want, we can do like a little bit of a round trip, starting in Asia and then moving over to Europe to end in the US, because the midterm elections are in front of us, and might be a few interesting topics there as well. So are you okay with that?
Yeah, absolutely. Okay. Let's start.
So China. We just ended the Communist Party National Congress. Xi seems to be in for his third mandate, and probably elevated to a semi-god status soon. Do you expect anything now on the reopening of China? Are they going to continue to be restrictive, and on the more on the monetary and fiscal policy side, do you expect the PBOC, for instance, to continue to inject liquidity, fiscality being supportive? What's your view if you have one over there?
Yeah, the first thing that I believe we need to understand is that the slowdown of China that is constantly disguised under the umbrella of the COVID-0 policy has a more fundamental problem, which is the burst of the real estate bubble. And the real estate bubble in China was enormous. The real estate sector, directly and indirectly, weighed about 29% of GDP in China. So that is a much larger problem than everything else that keeps headlines busy. So the point that I'm trying to make is that in order to think that fiscal policy or monetary policy are going to be supportive, you have to say, yes, they are going to be supportive. Obviously, they are going to be supportive. You would have had a massive Lehman-sized problem if that wasn't the case. But you cannot expect that level of support is going to generate the kind of growth that some of the market participants require in order to justify the valuations of Chinese assets. So continue to be prudent about China. Intervention is going to strengthen, if that is the word, or worsen, actually. If anything can be taken out of the Communist Party meeting is that the economy is not opening up, it's closing down.
You think so?
Yeah, I do. And I think that and it's been going for a decade. There's a great book behind me called We Have Been Harmonized that all of you are welcome to read. Is not written by me, but it's a great book. And it's a read that one. Okay. But it shows how the Chinese economy has been closing down for almost a decade. So the point that I'm trying to make, continue to be prudent about China. The growth will be there, but it's not yet there because the real estate issue is a much larger one that the market seems to be discounting.
It's funny that you say that, because this week, perhaps on a bit of hopium, the credit market in China hasn't been doing that badly, but perhaps it's been put a little bit on hold due to the Chinese Communist Party National Congress as well. And as we know, the GDP data have been delayed. So now the market is worried that it's going to be absolutely dismal, and because of the delay.
Yeah.
But yeah, I mean, so your opinion is it's not going to open. So, and then widen it up a little bit to, okay, I don't really want to talk about the Ukrainian war and Russia.
Yeah.
But we're seeing this line between China, Russia, then some of the BRICS countries as well. Do you think that there is like the gap between them and the rest of the world getting larger and more stressful in a way for investors?
Absolutely.
Oh, we're getting broken up.
Yes, I completely agree with that. Hear me? You well?
Hang on a minute, because we're getting broken up. Yeah, come again, Daniel, please.
Yeah, sorry, you broke up just a little bit.
Okay, phenomenal. No, as I was, you asked if there's a divide between two parts of the world, and absolutely it is, and it's getting worse, or at least getting more aggressive. No, there's certainly some sort of allegiance of sorts between China and Russia, probably an uncomfortable one, as it's always been in history, and I think that history repeats itself. And it's so we're going very much step by step toward what would be akin to the 70s, but not exactly the same. No, we're not going to go 100% back in terms of globalization, but certainly there is a huge gap between those countries that you mentioned, the BRIC countries, and obviously the developed nations, the European Union, the UK, the United States. So I think that is going to widen, and we should all incorporate into our investment thesis the valuation gap that lower security, lower investor security, lower legal security entails.
Yeah. Okay. Thank you very much for that. And then staying a little bit in Asia, Japan. We're seeing Japan is wrestling with the stimulus that they are putting in place. At the same time, the Bank of Japan is keeping the YCC in place, and at the same time they have to intervene in the Japanese yen, because the Japanese yen is really losing value very, very, very quickly, and it's putting a stress on their economy, because they have to import all of their energy virtually. And where do you see this thing ending? And I'm going to use like a very big term, and I'm doing it voluntarily. Is Japan imploding?
Japan is imploding. Japan has been the poster boy of all the Keynesian miracle ideas, because everybody in the print to grow community, if that exists, were saying, well, look at Japan, there's no problem. You print all the money that you want, you get into the highest level of debt in the world, and there's no problem. And everything is going well, so why not copy what Japan was doing? And obviously all of that was predicated on ignoring that in Japan you had extremely low inflation, thanks to the fact that they purchased their own bonds, and that because there was extremely low inflation, they continued to purchase their own bonds at yields that were completely detached from reality. So it was a bubble, and bubbles always take a long time to build, that bursts the moment that inflation mildly appears, because then the entire cookie crumbles. The yen suddenly stops being a strong currency relative to the US dollar, because everybody sees that they need to sell more yens in order to import, and they, at the same time, that they need those yens are not going to support an economy that is stagnant and overly indebted. No. So obviously the Bank of Japan comes out and says, okay, we're going to intervene, and we're going to prevent this, what they call extraordinary currency moves. Phenomenal. They intervene by doing what? They sell dollars, so they lose reserves, the yen gets even lower. Oh, what a genius idea. So the problem is that implosion, if inflation was temporary, it would have lasted very little. It would have been very quick. The problem is that inflation is not temporary, then they have a huge, huge problem. And in the case of Japan, bad inflation is 3%. Because because we talked about the pension funds in the UK before. But I remember in the 90s when I used to travel to Japan, when people used to say, oh, no, we're fine with 1% yield. Well, there you go. That is what you're getting.
Yeah, and in fact, what they are doing now is a bit of a spiral, because also I think a lot of the ideas are, because of our aging population, it is deflationary.
Yeah.
So inflation should not ever be a problem. But their problem is now the imported inflation is overwhelming, right? And they have, since their biggest companies are producing outside, they don't have a lot to counter the thing from the inside, right? Okay, that's great. Thank you very much. And then, so we're moving on, traveling again, and somewhere where you are now located, the EU. What's happening in the EU? Because we've had like massive tail risk. We have massive risks on the energy front. But then lately we have seen the energy prices starting to come down. In Spain, they are blocking ships on sea because the gas storages are full. But then on the other side, we're seeing governments needing to put in place more stimulus. We have Germany putting in place 200 billion euros without asking anyone their opinion, basically. And for everybody who thinks that EU is a solid bloc, perhaps you're living there. You can explain a little bit to our audience that it's not really the case. But anyway, I mean, what's your view for the moment on the EU and what's happening there? And you touched already on it. The spillover effects from what may be happening in the UK. But then, what's the view from the inside? And what's the difference between when we talk about the northern and the southern part of Europe, like all those little differences, and what is your view on that one?
The challenge of the Eurozone is huge. And the reason why it's huge is because the problems are self-inflicted. The energy crisis is obviously now very evident, but extremely high energy prices were already a problem of the Eurozone prior to the Ukraine war and certainly prior to COVID. So, so that is a problem. Obviously, what happens, and this is very typical of the Eurozone, is that you when it's mild, as it is today, it's a beautiful day out there. You don't need to in the middle of October. So when it's mild, they say, oh, everything is solved. You know, natural gas ships don't need to come to our shores. We don't need to store anymore. What is the problem? The problem that is happening is that it doesn't solve anything, because when you have an energy mix that has been directed to a larger percentage of volatile and intermittent technologies like solar and wind, it doesn't even matter that you have very high levels of storage when it's mild. The problem is that when it's very cold or when it's very warm, and is that there is no real alternative to gas, to natural gas. So the European Union problem is significantly more challenging than what the headline says. Not just the energy crisis, which it is. It is not just the slowdown of the German economy because of exports to China and the energy crisis combined, which is also true, but it's also a problem that we tend to forget. The two significant problems. We mentioned Japan before, aging population. Aging population is a problem in the Eurozone. Second, technology. The Eurozone doesn't have technology giants. So when it doesn't have technology giants, it doesn't have the cushions that China or the United States have in difficult periods for the economy, in terms of added value, in terms of added value. So that is a challenge. So I'm extremely concerned about a European Union set of governments that are thinking about the energy problem and are thinking about the slowdown as a winter problem that will be solved in March. Unfortunately, I think that it's a much larger problem, that it was pretty evident in 2019. Think about this. I think that somebody posted that the world was doing pretty well before COVID. Well, in 2019, fourth quarter, Germany was already on the verge of recession. France was growing 0%. and Italy as well. So big challenge, huh? Big challenge there.
And as well as you say, we have. Well, I'm European, even living in the UK, but I'm European. We have a problem with anything that we want to realize in the Eurozone, because there's so many different opinions and so many different interests that we can see it. If anything has to be decided on the European side, it's always taking much longer than anywhere else, right?
Yes, because to start with, because if you think about this, even an enormous economy and country like the United States or China, the strategies toward each of the regions are not built to be a minimum common denominator. It's only the European Union that thinks in this concept of everything has to be harmonized, the only one. Because everybody else looks at, well, what are the challenges in the south? What are the challenges in the east? I don't know, depending on the state, everybody's thinking from a much more diverse way of thinking about the economy rather than the Eurozone, in which it seems that when Germany has a problem, everybody has to adapt to Germany's problem. When France has a problem, everybody has to adapt to France's problem, instead of taking out the best of what each of the economies can offer. No? So that is a challenge. That is a challenge.
Absolutely. Okay, we've already spoken a little bit about the UK, so I think, okay, for the time being, there's again a leadership change going on with all the uncertainties that it entails. I think there's a bit too many uncertainties now to really stick some how shall I say, a post-it on it and saying like it's okay or it's screwed. I mean, we're still in the lower end, rather on the screwed side than on the okay side. But I really wanted to take you to the US and then have a look at what your view is perhaps on the upcoming midterm elections. And then once we've done that, just a quick then overlook at, because you're a specialist on a real specialist on the energy sector and supply and demand and stuff. So a quick look at the US and then an overview of who is winning and who is losing this supply energy, how shall I say, sea or ocean, or what is moving, and who is going to be the winners and the losers here. So in the US now, for instance, we are like Fed hiking rates, we're in QT, and then we have midterm elections coming up, and then yesterday a very well sent Wall Street Journal article saying that, right, the Fed is going to do 75, and then they are going to look at perhaps starting to slow down and things. So how does that fit with those midterm elections, and what is going on in the US on an economic point of view versus the rest of the globe then?
From an economic viewpoint, the United States is certainly shielded from some of the challenges that the Eurozone has on the monetary and on the energy side, certainly. Obviously, it has the world reserve currency, the US dollar strengthens, the euro collapses. But the economy is not doing particularly well, no? Now we've had to be told that 2 quarters of negative growth in GDP are not recession. But the US economy is in a technical recession. Does it mean that unemployment is going to go through the roof? Not yet, because it's a more dynamic economy than the Eurozone, than Japan, than others, no? And obviously that employment is not a leading indicator, it's a lagging indicator. No? So the US economy is obviously suffering from high inflation. Is the biggest problem for the US economy. The US economy does phenomenally with low inflation. High inflation never worked. So I think that is going to be the big challenge, because everybody's expecting the midterms as a catalyst, and then the Fed to pivot. Those are the catalysts. Nobody is changing their portfolios because everybody's thinking that those are the 2 catalysts. Midterms are a very unclear catalyst to me, because the idea that if you lose Congress or Senate, then that is going to completely invalidate policy has proven to be wrong. and it's proven to be wrong, both with Trump and with Biden. But the other problem is this idea that the Fed is going to pivot just because the market is not doing well. That is not necessarily the case. And I think that in this particular case, because we're seeing employment still holding on pretty well, and I think that it will continue to hold on pretty well for what I gathered when I just came back from the United States, is that the Fed has already given us the tool to understand why they will not slow down in a recession. It's because they haven't slowed down in what is already a recession.
Right.
So I think that they need to continue. And I think that they need to continue because they also see that the biggest challenges that hiking rates would have created for the US economy, at least so far, they have been able to pass them over to the rest of the world in currency depreciation. So I think that the United States, from a perspective of where to put money when you look for a bounce, I think that is the place. I think that you need to look, that is the place.
In 2 words, the US is the US dollar is the rest of the world's problem, not the American problem. That is
absolutely. I always say it the other way around. I always say that if you decide to play the Fed without having the world reserve currency, you have to stick to the consequences. Because because the ECB, the Bank of England, the Bank of Japan, the central banks of Latin America, etc., all of them played quantitative easing and let's do crazy monetary policy without having the luxury of being the world reserve currency. So now all of those have to deal with the consequences.
And that really brings me to a question that I wanted to bring up before we start addressing some questions from other attendees right now. And if you have questions for Daniel, please bring them in. I see a few of them coming in. I had a little bit of a chuckle when you said, well, the weather's nice and people aren't really worried about the energy crisis today because the weather's so nice. I live in the Western United States where we're going through a drought, but in the wintertime, when the weather's nice, no one talks about it. In the summertime, when it's so hot, everybody talks about it. So let's talk about the dollar and its reserve currency status right now, because everybody talks about the dollar when it's dying and it's under pressure. But right now it's at 20 some odd year highs on the index and obviously 30-year highs against the yen, so on and so forth. How close do you think the world is to trying to move away from a dollar-centric world? Are we just kind of stuck with the dollar as a reserve currency? I mean, how close is China? But when China manages their float, and they don't have depth in their bond markets. What do you think? What do you think the future is for the dollar?
Well, unfortunately, if this crisis is showing anything, is that the US dollar has cemented its position as global reserve currency for a few more years, because everybody played the same mistakes of the Federal Reserve without having the world reserve currency, and now they're dealing with the consequences, as I said before. So what is the problem of the global world reserve status? Is that there's no alternative. No. We found out, all of us, through reality, that cryptocurrency's liquidity was US dollars. So obviously, that was the Achilles heel of cryptocurrencies. We found out that the ECB's strategy, which much more aggressive than the Fed's strategy, which meant that the euro lost its option to be a world reserve currency. And we can look at any other option. But at the end of the day, when we think of why a currency is a world reserve currency, we need to think about what that means. That means liquidity. And the dollar is, in a fire, the house with the biggest number of windows and doors. And any other currency is unable to be a world reserve currency precisely because of the liquidity problem. So those that try to be an alternative to the US dollar in periods of growth they do it by they try to increase their breadth of liquidity, the length and the width of the highway, by doing the same mistakes that the Federal Reserve makes. But then the Federal Reserve only has to do one thing, which is to hike rates. And it's literally like bringing down the curtain and showing that everybody's naked. And so all of us understand that the Federal Reserve's policies are not the best in the world, and I certainly don't condone the vast majority of them. But when everybody else is worse, is that there's no alternative. This is currency. There's a book out there, which is Money Sound Around Sound, that says that in the world of currencies, it's not about who wins, it's about who loses. And right now, everybody else is losing.
Do you think China would be able to take the mantle?
It's very difficult because let me start. It's not just very difficult, it's that I don't think that China wants to do it. And the reason why China doesn't want to do it is that having a free-floating, massive liquidity currency, would it make it impossible for them to undertake a strategy like the one that they're having today? Right now, China is dealing with its property problems precisely with capital controls, with interventions, etc., that they can sort of navigate, not disguise, but navigate in a way in which if they had the world reserve currency, it would be Lehman squared. No. So the problem is in it, when it's not the problem, is that first they can't, because you cannot have a world reserve currency with capital controls, and second is that I don't think that they want to.
That's interesting. We got a couple of questions that came in from some viewers. First of all, with the ECB coming up this Thursday, let's talk near term. Is it Thursday or Wednesday? I forget. Anyway, with the ECB coming up, what do you think the ECB is going to do?
I think they're going to hike rates. It's probably a 75 basis points increase in rates. However, on the dovish side, I think that they will extend the fragmentation tools that they're implementing in order to keep the bond yields of Spain and Italy relatively stable.
But
all right,
on that point, because that's interesting, what do you think that they will do with their asset program? Because now that the chat in the market, or the expectations, or it's a bit 50-50, will they stop it somewhere in spring, or will they already bring it forward to the end of December, or are they stuffed and it's APP into eternity?
I think to be fairly honest, I think that the ECB doesn't have a lot of options to other than to continue with it at least until February, March, because there's no secondary market demand at these levels for all of those bonds that are maturing. So I don't think that they have a lot of options. They have to decide between showing strength or showing weakness, and I believe that they are going to hike rates but continue with the purchase.
Those dovish hikes. Caroli asks, as of now, it looks like the UK jumped from sinking ship of the EU. Will Brexit end up saving Britain?
Will Brexit end up saving Britain? I don't think Brexit in itself saves anything. I think that if I have to say anything, is that as somebody that lives between the European Union and the UK, is that it's incredibly disappointing to see that the promise of Brexit, of what it was going to be, the new Switzerland, deregulated, losing all the elements of the European Union that were a hinder on growth. All of those things have not happened. It's not just that they're not happened; is that this is the opposite. Is that instead of being a more Switzerland type of economy, it's becoming more of a Belgium type of economy, and so no, I don't think it'll save it. But I think that obviously the ship has sailed. I don't think that there was any option, any possibility of both to reconvene and continue together.
All right, there's one last question that I have here from one of our attendees that says or asks, do you see the EU building more infrastructure to connect Spain, which has had 3 LNG ports, and try to solve the energy problem that way?
No, it doesn't solve the energy problem, because the interconnection between Spain and France, I forgot, but
That's all right. Here we are.
the interconnection between France and Spain is a very small part of the problem, but it doesn't solve the big problem, which is that all of the infrastructure in Europe is built for gas to move from Russia down, not from the south up. So in France, the pipelines that go northwest and northeast are not built to have increased capacity or a complete change of flow. No, so it's not. So that is a part, but it's not even the beginning of the solution. And coming back to energy, our friend asked about winners and losers.
Yeah,
the U.S. is the big winner. The U.S. is the big winner in this environment. I think it's proven to be because of the gas crisis. And China is the big winner of the energy transition, because everybody in Europe says, we're going to build this massive renewable rollout that is going to reduce the dependency on Russia. And then what I say everywhere, and very few people, maybe they hear, but they don't listen, is you're going to go from depending on Russia to depending on Russia and China, because rare earths, lithium, aluminum, copper, all of these things, the main area that China has done has developed in the past years has been to secure the mining aspect of every possible area in Africa and Latin America. So it's going to be China and the US because of the energy position, both domestically and in terms of the commodities that are required to build batteries, solar panels, and wind turbines.
So,
Blake, if I may.
Yeah, Steve, please. Steve, our COO.
Hello. I'm an economist as well. I've been listening in, and I want to ask you something. We've been saying about on how many fronts the US has been winning due to the divergence of monetary policy. It's the dollar strengthening. It's the position of the US dollar also as a world reserve currency under current circumstances that is strengthening. There is, though, a big elephant in the room.
Yeah.
Last financial crisis in 2007, 2008, the US that had similar rates to today had a total debt of below 10 trillion. And the current debt is has shorter term maturities, a lot shorter than it had back then. And the debt has surpassed now 31 trillion. What happens what has to happen, and when does the market focus on that front, the fiscal front, and the unsustainability of it?
Yeah, it is clearly a challenge. The problem in the world is that, as you traders know perfectly, is that everything is relative.
Yes.
So the problem that the United States has, you've just outlined perfectly. But when the Eurozone goes into the same problem, China goes into the same problem. China is a very indebted economy. Japan goes into the same problem. Then I come back, as long as you have the investor security, the legal security, and the attraction of capital, simply a hike in rates in the United States massively creates a vacuum of demand for US dollars globally. So, and you mentioned there's $31 trillion of US debt. Absolutely, there are. What are the reserves of the Chinese PBOC or the world's central banks when we hear China has $3 trillion of dollars? It's bonds. That's what they have. That's so ultimately, the US's enormous fiscal problem, which is pretty evident, is only supported by the fact that the contenders are stupid enough to get into much worse problems. So in essence, if you look at it from a geopolitical standpoint, this is very similar to the Cold War. The United States is in a very bad fiscal position, enters into a Cold War against the Soviet Union to see who loses first, not who wins, who loses first. And unfortunately, by falling into the trap of making the same mistakes as the United States, the Eurozone, Japan, the UK, China, all of them have basically allowed the US to win in relative terms, not in absolute terms, which you're absolutely right.
Thank you.
Well,
Thank you very much.
Daniel, I have to say
Thank
this
you.
has been one of the most, you know, I'm going to probably echo some comments from some of my other colleagues here. You tell us how it is, and you tell people how it is, and I think that we can all really appreciate about you and about your style of how you present what's happening in real time. Guys, did you have any other comments for Daniel before we let him go?
No, not my end. I just want to say muchas gracias, and hopefully we can do this again soon, because it's extremely interesting. Thank you very much.
Thank you very
Have a
much.
great, thank you very much. Have a great one. Bye-bye.